What is the Fed? Welcome to Money and Good Sense. The Federal Reserve, often simply called the Fed, is regularly mentioned in the news. Whenever interest rates change, inflation rises, or the economy slows down, you will almost always hear about the Federal Reserve. But why is the Federal Reserve so important? The answer is simple. The US dollar is the world's primary reserve currency and is used in international trade and finance every single day. As a result, decisions made by the Federal Reserve often affect not only the United States, but economies and financial markets around the world. But what exactly is the Federal Reserve? Why was it created? And why do its decisions affect mortgages, saving accounts, investments, businesses, and even the global economy? In this video, we will explain what the Federal Reserve is, why it was established, how it works, and the role it plays in the American economy. Because to understand the US economy, it is important to understand the institution responsible for the country's monetary policy. Why does the Federal Reserve exist? Before the Federal Reserve was created, the United States did not have a single central bank responsible for the country's monetary policy. Instead, the American banking system consisted of thousands of private banks, each operating largely independently. During the 19th and the early 20th centuries, the United States experienced several severe financial crises. When confidence in the banking system declined, people rushed to withdraw their money, causing banks to fail and the economy to slow down. One of the most serious banking crises occurred in 1907 and convinced many political and financial leaders that the country needed a more stable financial system. As a result, the Federal Reserve System was established in 1913. Its purpose was to provide stability to the banking system, support the flow of money through the economy, and help reduce the risk of future financial crises. Today, the Federal Reserve serves as the central bank of the United States and is responsible for the country's monetary policy. The Fed's main objectives. The Federal Reserve has two official objectives. These objectives are often referred to as the Fed's dual mandate. The first objective is to maintain price stability. Just like the European Central Bank, the Federal Reserve aims to keep inflation low and stable over the long term. Stable prices help protect the purchasing power of money and create a healthier economic environment for households and businesses. The second objective is to promote maximum employment. In other words, the Federal Reserve tries to support an economy in which as many people as possible who want to work are able to find a job. A strong labor market benefits workers, businesses, and the economy as a whole. These two objectives are closely connected. If the economy grows too quickly, inflation may become too high. If the economy slows down too much, unemployment may increase. One of the Federal Reserve's biggest challenges is finding the right balance between keeping inflation under control and supporting a strong job market. Unlike the European Central Bank, which focuses primarily on price stability, the Federal Reserve has two equally important objectives. Interest rates. To achieve its two main objectives, the Federal Reserve uses several monetary policy tools. By far the most important of these is the federal funds rate. This is the interest rate that influences borrowing costs throughout the American economy. When the Federal Reserve raises interest rates, borrowing becomes more expensive. As a result, households and businesses usually borrow less, spend less, and invest less. This helps to slow down the economy and reduce inflation. When the Federal Reserve lowers interest rates, borrowing becomes cheaper and more attractive. Households are more likely to buy homes, cars, and other goods, while businesses are more willing to invest and expand. This often leads to higher spending, stronger economic growth, and more jobs. Changes in interest rates also affect mortgage rates, business loans, saving accounts, and many investment decisions. For the Federal Reserve, interest rates are the most important tool for influencing the economy. By raising or lowering interest rates, the Fed tries to maintain stable prices while also supporting maximum employment. The Federal Reserve and commercial banks. The Federal Reserve does not lend money directly to households or businesses. Instead, it mainly works through commercial banks. Commercial banks play an important role in the American financial system because they provide mortgages, personal loans, business loans, and saving accounts. When commercial banks need additional funds, they can borrow money within the banking system under conditions that are strongly influenced by the Federal Reserve. The Federal Reserve also influences the interest rates that banks pay and receive on short-term funds. As a result, changes in the federal funds rate gradually affect borrowing costs throughout the entire economy. Commercial banks pass these changes on through the interest rates they charge on mortgages, personal loans, business loans, and the interest they pay on saving accounts. This means that when the Federal Reserve changes interest rates, the effects are eventually felt by households and businesses across the United States. Although most people never deal directly with the Federal Reserve, its decisions influence many of the financial choices they make every day. Why does the world watch the Fed? The Federal Reserve is the central bank of the United States, but its influence extends far beyond America's borders. The main reason is the US dollar. The US dollar is the world's primary reserve currency and is the most widely used currency in international trade and finance. Central banks around the world hold large amounts of US dollars as part of their foreign exchange reserves. Many international loans issued in dollars, and a large share of global trade is settled in US currency. Important commodities such as oil, natural gas, and many industrial metals are also traded primarily in dollars. Because of this, changes in the US interest rates can affect exchange rates, international trade, and financial markets around the world. When the Federal Reserve raises interest rates, investors are often attracted to US dollar investments because they may offer higher returns. As a result, money can flow into the United States, while other countries may experiencing weaker currencies, higher borrowing costs, or slower economic growth. When the Federal Reserve lowers interest rates, the opposite can happen. This is why a decision made by the Federal Reserve in Washington can influence businesses, governments, and investors, not only in the United States, but also in Europe, Asia, and many other parts of the world. That is why the world closely watches every decision made by the Federal Reserve. Who makes Federal Reserve decisions? The Federal Reserve does not make decisions through a single person. Instead, important monetary policy decisions are made by a group of experienced policymakers. At the center of this process is the Federal Open Market Committee, also known as the FOMC. The FOMC is responsible for setting the federal funds rate and determining the direction of the U.S. monetary policy. The committee includes the members of the Board of Governors, the President of the Federal Reserve Bank of New York, and a rotating group of presidents from the other regional Federal Reserve banks. Together, they regularly meet to review economic conditions, including inflation, employment, economic growth, and financial markets. Based on this information, they decide whether interest rates should be raised, lowered, or left unchanged. Although the chair of the Federal Reserve leads these meetings and plays an important public role, decisions are not made by the chair alone. Instead, they are made collectively by the members of the Federal Open Market Committee. This helps ensure that monetary policy reflects a broad range of economic information and perspectives from across the United States. Conclusion. The Federal Reserve is much more than the central bank of the United States. It is responsible for maintaining price stability and supporting maximum employment through monetary policy. To achieve these goals, it uses interest rates to influence borrowing, spending, saving, and investing throughout the economy. But the Federal Reserve's influence extends far beyond America's borders. Because the US dollar is the world's primary reserve currency, its decisions often affect exchange rates, international trade, financial markets, and economies across the globe. Every interest rate decision made by the Federal Reserve can influence millions of households, businesses, investors, and governments. That is why the Federal Reserve meetings are closely watched not only in the United States, but all over the world. Understanding the Federal Reserve helps you better understand not only the American economy, but also many of the economic and financial developments that shape the global economy. Behind many of the world's biggest economic and financial developments lies the monetary policy of the Federal Reserve. That is why the Federal Reserve is one of the most influential financial institutions in the world. Thank you for watching, and as always, don't worry too much. Everything can be overcome with study and patience.